This is Trade Flow News, bringing you relevant news and insights from around the world. Trade Flow News, enabling trade for SMEs and economies worldwide.
Welcome back to TradeFlow TV. You know the drill. Markets move fast, and if you're not ahead, you're under. It is Tuesday morning, June 16th, 2026, and global commodity desks are actively digesting the massive shockwaves from yesterday's trading session. The initial panic selling in energy from the preliminary U.S. Iran peace understanding is beginning to stabilize, leaving structural realities in metals and agriculture exposed to the morning light. Let's get you caught up for the opening bell. First up, the 60-second commodities flash. Brent consolidates at $83. Following yesterday's brutal 4.7% collapse, Brent crude is holding steady in the $83.10 to $83.40 a barrel range this morning, with WTI hovering near $80.60. While paper markets successfully priced out the immediate war premium, physical traders are focused on the timeline for clearing the maritime backlog. Meanwhile, the copper vacuum intensifies. Industrial metals are completely ignoring the energy correction. LME copper cash settlement remains locked near $13,600 per ton. Severe concentrate shortages and a global deficit of processing inputs are colliding with massive structural demand from global AI data center developments. Gold bases under its moving average. Precious metals are attempting to find a structural floor. Gold is trading flat just below its 200-day moving average, around $4,530 per ounce, caught between a sticky U.S. producer price index tracking at 6.5% and fading geopolitical safe haven bids. Caught between a sticky U.S. producer price index tracking at 6.5% and fading geopolitical safe haven bids. Finally, agri-desks eye a harvest deficit. Grain markets are continuing to reprice the USDA's June WASDE shock, with U.S. all-wheat production officially slashed to 1,543 million bushels and yields downgraded to 47.0 bushels per acre. Domestic protein premiums are beginning to aggressively decouple from weaker global benchmarks. Let us take a deep dive into the physical supply constraints reasserting control over industrial tech metals and agriculture as the energy paper market finds its new baseline. The data hitting global terminals this Tuesday morning confirms that yesterday's knee-jerk selling has created a massive opportunity. Smart money is rotating out of speculative energy shorts and moving into physical deficits. Here is what you need to track. Look at the post-peace logistical reality. The headlines claim the Strait of Hormuz will reopen by the end of the week, but a paper treaty cannot instantly move stranded physical inventory. Even as the maritime blockade dissolves, insurers are facing a massive backlog of commercial vessels requiring updated risk premiums. Production facilities that were shut in during the peak of the conflict will require weeks of technical validation before hitting peak throughput. Crude at $83 is a fragile baseline. Expect strong structural support through the summer as physical flows lag behind political promises. While oil finds its footing, the base metals complex is demonstrating pure structural strength. Copper has officially evolved from a standard cyclical manufacturing input into a primary tech infrastructure asset. On the production side, the spot treatment charge index remains highly depressed, indicating that global smelters are starved for raw copper concentrate. On the consumption side, the unrelenting build-out of high-density AI server racks and energy grid expansions is swallowing up physical float faster than mining majors can extract it. Do not let the drop in energy blind you to the quiet explosion in soft commodities. Grains are responding directly to structural crop failures, not geopolitical headlines. The June WASDE report confirmed that high-protein hard red winter wheat supplies are severely limited, compressing ending stocks across the domestic agricultural belt. As a result, domestic grain processors are actively building long-term hedges to protect themselves against elevated consumer food index tracking later this year. Here is the trade flow take. The initial relief rally from yesterday has run its course. Today is about recognizing structural shortages. Avoid chasing short positions on crude at these compressed levels while maritime logjams persist. Maintain strong accumulation targets in industrial base metal miners and prepare your portfolios for localized premium hikes across the agricultural complex. Stay liquid, stay sharp. See you on the next one.
That is all for today's news on commodity markets. Stay tuned to Trade Flow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at Trade Flow News, which allows you to watch our program on your mobile device or desktop to receive information from there.